In the Forex market, you don't always need to be glued to the screen to take advantage of market opportunities. Pending orders are a powerful tool that allows traders to plan their trades and have them executed automatically when the market hits specific levels. This functionality not only saves time, but also helps maintain discipline and eliminates impulsive decisions. Pending orders are instructions given to your broker to open a trade at a predetermined future price. Unlike a market order, which is executed immediately at the current price, pending orders only trigger when the price reaches the level you've set. This is especially useful in a fast-moving market like Forex, where prices can shift quickly in any direction. There are several types of pending orders, and each serves a specific purpose. The two main categories are limit orders and stop orders. Within these categories, there are subtypes that cater to different trading strategies. First, we have limit orders, which include buy limit and sell limit. A buy limit is used when you want to buy at a price lower than the current price. For instance, if EU or HOC USD is at $1,000 and you believe it will drop to 1,900 before going up, you could set a buy limit at 1,900. On the other hand, a sell limit is used to sell at a higher price than the current one. This is useful when you expect the price to rise to a certain level before reversing, such as setting a sell limit at 1,1200 when the current price is 1,1000. Next, we have stop orders, which include buy stop and sell stop. A buy stop is used when you want to buy at a higher price than the current one, expecting the market to continue rising after hitting that level. For example, if the price is at 1,1000 and you believe that a strong bullish move will occur after breaking 1,1100, you would place a buy stop at 1,1100. Conversely, a sell stop is used to sell at a price lower than the current one, anticipating the price will continue falling after breaking a level. The great advantage of pending orders is that they eliminate the need to constantly monitor the market. They also allow you to act with more precision, as you can set your entry levels based on technical and fundamental analysis, without the pressure of the moment. However, it's important to note that using pending orders doesn't guarantee success. Markets can be unpredictable, and sometimes prices may hit specific levels only to reverse immediately, triggering the order and leading to losses. Therefore, it's always essential to accompany pending orders with good risk management by using stop-loss and take-profit levels to protect your capital. In conclusion, pending orders are an indispensable tool for any trader looking to trade more efficiently and disciplined. By learning to use them correctly, you can plan your trades in advance, reduce stress, and maximize opportunities in the Forex market, even when you're not in front of your computer.